Good afternoon, everyone. My name is Greg Robb. I'm the economics editor at MarketWatch, and I'd like to welcome to our conversation today Margarita Cheng. She's the CEO of Blue Ocean Global Wealth, and also Yaneli Espinal, who's Director of Educational Outreach at NextGen Personal Finance, specialist in financial literacy. Welcome, Margarita and Yaneli.
Thank you.
Thank you.
It's really good to have you today. I think Americans are waking up into this new environment of higher prices and their paychecks not going as far as they used to go. Margarita, have you been seeing customers stressed about inflation?
Inflation has been a cause of concern for clients and consumers in general, not just higher prices at the gas pump, but food and healthcare.
And what are you been telling them when they come with that initial shock?
Well, sure. I think there's several things that we are addressing. We are addressing inflationary risk, rising interest rates, and stock market volatility. This is on top of the situation in Ukraine, and I'd be remiss if I didn't acknowledge that. So what I've been telling clients is it's really important that we are mindful of the different types of risk. There is inflation risk, right? That means that your dollars don't go as far. It means that there's also market risk, but then we also need to make sure it can be very tempting to purchase investments that yield higher returns, but those investments may not be appropriate because of what I call liquidity risk. You may not be able to get your dollars when you need them most. So I make sure that I'm addressing all of these risks at the same time.
Nelly, I'd like to follow up with you. Like, what do you say when people ask you about this high inflation, what they're feeling?
Yeah, I mean, I think that people are feeling frustration, and rightfully so, because a lot of times the way that this conversation about inflation is framed, it's giving people advice about what to do to protect themselves or protect their cash from inflation. But people need information about what to do during inflation. You know, it's one thing to talk about preventative measures, but we're in the thick of some of the highest inflationary rates we've seen in 40 years. And people sort of get frustrated when you tell them, you know, think about diversified investments, consider real estate, perhaps gold. It's like, we need to know what to do right now to afford things that used to cost a lot less weeks, months ago. So I think that one of the things we tell people is we validate what their experience is. And a lot of times we work with teachers and we're working with students in schools. And so we validate that everyday people are feeling frustrated and feeling like we're strapped for cash. So we try and look for ways that they can kind of control their cash flow in a way that kind of helps them to think about what's in their control and not be too frustrated or focused on the things that are outside of their control.
I should be remiss to tell everyone that please put some questions in the chat, and we'll try to answer some questions before we finish. And, you know, I talk a little bit more about control. So you want people to look at what they're spending money on and kind of try to cut back a little bit.
Right. And I think that really is something that kind of starts early on, really thinking about what are the trade-offs that we make when we're creating a budget, when we're creating a financial plan. One of the things in our curriculum at NGPF that we do is actually do simulative experiences with students where they actually have to simulate creating a real budget. And some of them are, you know, activities where young students can use beans, for example, to say, I want to allocate 4 beans to, you know, my Wi-Fi and my devices and gadgets at home, but I'm only going to put 2 beans towards, you know, hanging out with my friends. Because to me, being at home and being connected to the internet and being able to use social media matters more than going out and hanging out with my friends. And so they would allocate more to the things that matter more. And those are, I think, the types of values and lessons that we have to really remind everybody of during high inflationary times. It's let's go back to our spending plan and let's look at where are we spending maybe more than we should? Where are areas where we can cut back, subscriptions we can cut? Where are there, you know, areas in the budget that we know that, you know, we maybe don't necessarily need to rely on? And so those are easy places to trim. And then what are actions we can take? Maybe we can lower our internet plan, lower our phone bill plan, maybe have a little bit less data, maybe call the bill collectors and ask them to negotiate those monthly bills down a little bit or further the payment date a little bit later in the month so that it allows you to stretch your dollars a little bit further. Because the reality is that's the strain on folks, everyday folks right now, is how can I stretch my dollars so that they can last me between my paychecks?
That's interesting. Margarita, any follow-up there? It's how do people navigate this, trying to negotiate with companies to keep their plans?
Sure, I think I agree with everything Yaneli said. We want people to be masters of their cash flow. We want them to control their cash flow and not feel a lack of control. So there are some things to think about. So, for example, instead of subscriptions, and I'm not suggesting that you cancel everything. If it brings you joy and you're using it, then by all means keep it. But sometimes it may make sense, instead of unlimited, to pay as you go. There's other options where, for example, you can share expenses. So perhaps you have one family member that has a Costco membership, but you don't go to Costco every month. You can share. And then if we look at online subscriptions for publications, so look at your utilization and then see if the plan you have is right for you. The other thing that I can tell you is even with, these are things that have been happening to people even before the numbers for inflation came out. So, for example, your auto insurance or homeowners insurance may have increased due to no fault of your own, right? So you can contact your company and ask, maybe you can, if you're working from home and driving less, see if there's a reduction there, increase your deductible. Here's something that is also very helpful about spending. We have seen an increase in property values. Some clients of mine actually were able to contact their mortgage company and eliminate the private mortgage insurance just because they had adequate equity. In some situations, you may have to pay for an appraisal, so I would caution people just to make sure. In other situations, you may not. These clients were able to save $112 a month. Now, I know 112 doesn't sound like a lot, but we need to multiply that by year, and that's a lot of money.
You know, does it make sense for people to go through their budget and maybe cut back to the bone and then rebuild it from the start? Does that make sense to you?
I mean, I think it definitely makes sense because it gives us an opportunity to just reflect on our spending habits in general. It's a good opportunity to sit down and say, let me revisit, my plan and see if I'm still in alignment with my values and with the way that I want to be spending my money, or if maybe my habits changed during the thick of the pandemic in a way that maybe doesn't serve me well financially. And so this is just a good opportunity, right, to come back and reflect and revisit. And I think it's a great chance for people to kind of reset, and which I think is valuable and important to do, on an annual basis. But particularly now during a high inflationary time, there's a lot of panic. And so being able to come back to a place of calm, revisit your money plan and look and see if you are on track to where you want to be and where you want to go, it can, provide a little bit of calm during a little bit of a storm that's happening right now with media and news, and headlines that can, create a little bit of panic for people. So I do think it's a great idea, but I would definitely encourage people to do that in a data-driven way. So instead of just looking at my budgetary items and seeing which categories I'm spending more or I'm spending less, I would actually look at the news and see where are the categories that have been more highly inflated than the average inflation rate right now. And we're seeing that those things are gasoline and used cars and trucks, so if there are opportunities for us to maybe delay purchasing a car right now and carpool instead and push that purchase into the future, that would be a good move to make when you're budgeting, because we know that that those types of purchases have just been so highly inflated. So really kind of making those decisions in a data-driven way, I think, is what's going to best serve people at this time.
Thank you so much for that. Margarita, it looks like so far a lot of the questions we have in our chat room are talking about what sort of investments make sense. So where do you guide people to invest their money now? One of our readers, Ricky, says, is it international stocks? What's your advice there?
So the first thing that I tell everyone, no matter how old you are, how long you've been investing, you want to first make sure you have that financial safety net. And that financial safety net means having that rainy day fund for any emergencies or opportunities arise. So you want to have your cash reserve. Then you want to also build wealth for your future. So there's short-term savings. So what I tell people is your short-term savings is not really going to fluctuate in value. And then your long-term investments, I'd be misrepresenting if I said that wasn't going to fluctuate. These are invested for the long term. Long term, I'm going to say 10 plus years retirement. So it's important to take advantage of dollar cost averaging. Many of us are doing that. That means investing a systematic amount in the market. And then diversification is key. So the longer your time frame, you're right, you probably can have more exposure to equities. Now that listener's question about international. So international does include developed markets in Europe and some countries in Asia, as well as the United States. But there's also emerging markets, which would be Brazil, Russia, India, China, and South Africa. So based on the issues we are seeing and experiencing in Ukraine, emerging markets are going to experience a lot of volatility. So my advice to everyone is take a look at where you're invested, right? And right now, the first quarter, you've seen those statements, the stock market did not cooperate or deliver positive returns in the first quarter. But remember, it's not the time you're in. It's not timing the market, but it's really the time in the market. And that is what is going to allow you to build wealth over time.
Anything there you want to follow up on?
Yeah, I would just add that I think that these are conversations that tend to be taboo. So I'm really glad that, Ricky asked that question, because I think adults tend to feel nervous about these things and not have these discussions, right? And so the more we talk about these things openly, the more we ask questions about, hey, where are you feeling comfortable investing? How much do you have in your emergency savings fund before you feel comfortable to begin investing? When we ask these questions and talk about these things openly, the next generation is listening in. And they're really worried right now with high inflation and with, the student loan crisis and with so much going on post-pandemic and during the pandemic. I think that the more we can talk about this and have this type of dialogue, which I'm so glad that we're having right now, the more we can then impart some of these really critical lessons onto the next generation, which I think, we obviously have a great opportunity to do right now, because this is a topic that is a hot topic and everybody's, wanting to weigh in and have this conversation. So let's involve the next generation in these conversations.
Great. It seems that in this new era of inflation, which we haven't seen since, the 80s and the 70s, over the last 40 years, we've sort of had these sort of old chestnuts about personal finance, about what to do, pay down your debt really quickly. Do things change when there's an environment like inflation? Should people act differently?
Absolutely. Well, first of all, I think that, for younger learners or for, millennials, this is probably the first time that they're experiencing something like this, right? They were either super young, the last time something like this happened, or they weren't born yet. And so there's a rightful reason and understanding why there's a little bit of panic. But I do think that when you go and look at some of the traditional types of advice, it maybe doesn't necessarily apply in this environment, like you said. And one of the specific pieces of advice that we tend to hear is focus on paying off high interest rate debt right now and make extra payments on debts that you have. And I think that when we're in a high inflationary period, cash is just so important, because the cash that you had yesterday, is just not going to cut it today. So you really need more cash to be able to do typical things that you did before around the house and, in your everyday life. So, cash kind of really has, there's more need for extra cash during high inflationary periods. So I do think that sending extra payments, for example, to your mortgage or to a personal loan or a student loan, just don't make sense right now, even though that is traditional advice that we tend to hear. And then another thing that I would say is a lot of times people will say, don't hoard cash. Once you hit your emergency savings fund goal amount, that's it. You should be investing everything else. But that might not necessarily apply right now. During high inflationary periods, you might feel more comfortable having extra cushion of cash because of the fact that you know that cash is going more quickly, month to month, week to week than it typically might.
Margarita, anything strike you in that conversation?
Well, I think, like Yaneli said, it's a perfect time to revisit your budget. And for those who have not had to make student loan payments for 2 years, I know you don't have to make loan payments now. But what I've encouraged everyone to do is be proactive or contact your loan servicer so that when those payments do kick in, if you've experienced a reduction in income or income volatility, request a different payment schedule. This is not going to damage your credit. I know you don't have to make payments now, but this way you are ahead of the curve and you can be prepared to make those payments. As far as paying off debt, I know that a lot of people, it's very exciting to pay off your mortgage. And if you do have extra resources and it is not impacting your other goals and priorities, then definitely take the time to revisit it. It may not be a situation where you have to pay it all at once, but you can take a measured approach to this. Because remember, once you pay your home off, if you want to do repairs, you can't ask the bank and say, hey, give me money. I know you can with a home equity line of credit, but interest rates are increasing, so that may not be the best strategy to pay everything off in a hurry.
Thank you for that. And we have a follow-up question, Margarita, about your rainy day fund. How long should it go for? For a year, for a couple of months, that you should have these expenses kind of squirreled away?
So some people say, you should have 3 to 6 months, 6 to 12 months, and it's not really your earnings, but really your expenses. Now, for people who have stable employment, maybe you can get away with a smaller amount. If you are a gig economy worker or you have a lot of incentive compensation, you may feel comfortable having 6 to 12 months. For people who are retired and subject to requirement distribution, I make sure that the amount that they have to take out of their IRAs and qualified accounts, I make sure that there's those dollars, I'm thinking 2 or 3 years ahead, so we don't have to sell equity mutual funds or equity ETFs at a loss.
And a question for both of you. I think one of the things that people are getting shocked by is the increase in rents. Is there anything you can do about that? I mean, should you try to talk to your landlord in some sense?
That's a tough one. That's a tough one because I think that landlords are feeling, the crunch financially and the pinch just as much as tenants are. And so I think that may be why some of the rents are going up, because it's being reflected on, the rent that you pay. But I think that, property taxes are also going up, and, landlords also have so much that they need to deal with financially. A lot of water bills or gas bills or things that a lot of times landlords may actually take responsibility for when they own a home are going up. So we might feel that, trickling down. And I speak for myself as a tenant, right? As a tenant, we feel that trickling down. But at the end of the day, I think that it's key to really just get creative about how you're utilizing your space. If you're self-employed or if you, work from home, think about tax efficiencies that you can utilize. I use my room. I have an extra room in my apartment where it's just, really just a guest room. And when I rarely have any guests, I'm really just working in here and working all day, every day in this space. This is my work, space. This is my home office. And so learning about what are the ways that you can, make sure that you're being efficient when you're filing taxes, but then also thinking about the fact that there's space in a lot of times when, people have an apartment that they're renting, if it comes with a parking spot or if they have space in a garage, like that you could be renting that space and you could be making income from that. And so really, I think that times like these make us get more creative about generating more income creatively, because oftentimes negotiating with a landlord might not always be successful, but it's something that I definitely wouldn't discourage anybody from doing. I would still encourage you to have a conversation with your landlord. And if it's getting to be something that you can't manage, discussing that with the landlord, being open about that and seeing if they're willing to work with you, because the landlord has financial responsibilities just like you have yours as a tenant. And just keeping that line of communication open, I think, is what's really important.
Marguerite, we have a question from Ashley, and she says, let me see if I can read this. In my 401k, which will net the lowest cost fees? A fund with a high turnover but low expense fee, or a lower turnover but higher expense fee?
So this is what's interesting. Within your 401k, because it is tax qualified, turnover isn't going to be as much as an issue in the sense that it is not going to generate a tax bill. In your 401k, I would look for like index-based funds, or even target date funds that are based on a different indices. I did want to say one thing about the rent. So this is what's interesting. Landlords are feeling the crunch. And just remember that there are costs to moving, meaning you have to pay movers, you have to pay a new security deposit. If you'd stayed in that property a while, like Yaneli was saying, there's only so much negotiating you can do. But the landlord may actually be willing to work with you, because once you move out, the landlord has to change the carpet, clean the apartment, replace the appliances. So if a cost increase is inevitable, maybe you can ask them to phase it over 6 months instead of all at once. The other thing that you can do is, if the appliances are older, maybe you can agree to not have such a tremendous increase in rent. And last but not least, if they have taken on the utilities in the past, you can negotiate with your landlord to maybe pay the water bill, for example. So just as though you are incurring costs, the moment you move out, they're not collecting any income from that unit.
Thanks for that. A question for you, Yaneli. Is there any special investment advice for retirees now?
For retirees, I think one of the things that we try to do is teach young people to think ahead about that, so that you have plenty of time to prepare for it. Because as a retiree, once you're out, and depending on your investment income, it can be tricky because your emotions are now involved, and you're not able to take the same amount of risks that you were able to take when you were still, in your professional working career and just gearing towards retirement, but not in the thick of it. So, I would definitely say, think about the risk tolerance that you're able to take. We tell students, think about what your life is going to look like when you're retired. If you have real estate properties and a business that's still generating income for you, you have some tenants living in a property that you are using to create cash flow, and you have a retirement account, an IRA or a 401k, you've got a lot of options to choose from. And so I think that would be the key, is to really try to create an environment for yourself as a retiree where you're not just diversifying within your investment portfolio, say in your 401k or in your Roth IRA, but diversifying the ways that you're able to get income as a retiree is super important as well.
Well, I think we're running very close out of time. I'd like to thank Margarita and Yaneli for joining us today. Do you think that there will be a recession? I guess that's one last question for both of you quickly. What's your gut sense?
Yaneli, you can go first.
I'll go first. I think that anytime I'm asked about whether there's going to be a recession, I get emails and the students ask about it all the time. I say, there is definitely going to be a recession. What we don't know is when it's going to happen. And so for us to sit here and say, oh, no, there won't be a recession. Recessions are part of the economic cycle. And so we know it's coming. We just don't know when. And so the best thing that we can do, instead of panicking about when it's going to be, we don't know, right? That's outside of our locus of control. So what we can focus on is what to do to prepare for it when it does come. Really making sure that we are, packing up our emergency savings fund so that we're comfortable with that amount of cash reserve. And then thinking about diversifying our investments so that we're growing our money and being able to at least make an attempt to combat these high inflationary times, right? And then finally, really thinking about our spending. Is it aligned with our values, or are we making, a bit of a frivolous decision making when it comes to money here and there, and things that we can kind of reel in and cut back on, at least until we hit our savings goals and investment goals. And so I think that those are the things that we can do. That's what we can focus on, rather than spending a ton of energy worrying about when the recession is going to happen.
I'm afraid that's going to be after our final word. Margarita, you'll get the first question the next time we meet.
No problem. Just no one plans for these things, but we need to be prepared.
That's right.
Thank you both so much.
Thank you.